instance, the fourth quarter GDP numbers came in a full 100 basis points, 1 percentage point higher than street expectations. There is a spring in the step of economic policymakers and economists. For policymakers more so because it means a little more elbow room. Indian macros are at their best. Growth better than expected, inflation lower than expected, current account deficit lower than expected. So that gives more policy maneuvering room. I have with me someone who combines the best of policy making and economic thinking. I have with me the Chief Economic Advisor, Dr. Anantha Nageswaran. Dr. Anand, thank you very much indeed for sparing time for us, and my thanks to the Morgan Stanley team for arranging this. Well, first up, yes, it's an excellent number, much better than even the government forecast, even RBI forecast.
Right.
What does that mean for you? Are you going to up the current year's forecast?
No, first of all, those numbers were obviously, as you mentioned, better than expected. But then I was not particularly surprised because when the third quarter numbers came out, there were a lot of concerns about loss of momentum, etc. And I was at that time explaining to members of the media and also others that those were because of the previous year's upward revisions, which kind of suppressed the base effect, played a big part. And I said the underlying data were strong enough that the fourth quarter will see a rebound, but this rebound has been very strong, which is good. And I think the momentum is sustaining in the current financial year based on 2 months of data which we are seeing so far. I may not have revised my estimate higher as others have done because they were coming from a lower level. We have 6.5%, but what I do feel, subject to the monsoon risk factors, etc., when we wrote the economic survey, we wrote that risks were more tilted to the downside to our number, but now I'm more comfortable saying that the risk to these number is more evenly balanced rather than tilted to one side. That is the step up in the level of confidence we have about the economy's ability to achieve that 6.5% real GDP number that we have penciled in.
Okay, but incoming data has been very strong. I mean, almost all US data have surprised to the upside.
That's right.
The latest jobs data being even more spectacular. Even in China, where April is a slowdown, the first quarter was above expectation. Jan, Feb, March. Now, actually, just today or in the last 24 hours, Goldman Sachs has revised down the chances of a recession from, I think, 35%, the odds are now 25% or less. So if the overall global headwinds are being seen as less, you don't think that our chances improve in terms of higher growth?
No, I mean, I would say that it is both good and bad. Not bad, it's a mixed bag for us because in general, global economy may not go into a recession, or the US economy for that matter, etc. Although Germany is not doing well, but US numbers have been surprisingly resilient, etc. All that is fine. But it is not that the global economy is firing on all cylinders for us to say that the trade contribution will be substantially higher because of that. It is not slowing as we might have feared, but it is not that it is sort of coming off the starting blocks with a great momentum. That's not the point. So on the contrary, I have always maintained in the last 6 or 8 months that a controlled slowdown in the global economy is what the doctor would order for India, given the positive implications it has for energy demand, energy prices, etc. To me, those effects dominate.
Okay.
Because our services exports are relatively more resilient, and the merchandise export growth will, even if the global economy isn't going into a recession, it is not going to be, sort of flying very high. So on balance, I would rather live in the global economy context with a sort of a controlled, restrained slowdown, which is not so destabilizing as to upset risk appetite, etc. So that is what would be ideal for our economy's requirements.
Even market economists say that a very speeding global economy will mean others who are more globally linked do better. We are a little more domestically oriented.
Sure.
But I'll, time permitting, come back to the current account deficit and the services exports, which have been such a brilliant performer. Let me just finish the GDP question. I'll just begin with one or two worry points in an otherwise brilliant GDP number. The private consumption. In at 2.8. This does look like Capex driven, construction driven GDP can sustain only if at some point demand returns.
Yeah.
Doesn't it worry you?
Look, I would say that yes, it could be better. So whether it worries us, that people can agree or disagree on the degree of worry that they have. First of all, private consumption overall as a share of GDP is at 58.5%. Yes, there is there is no clear momentum at the moment. But we know that pockets of urban consumption are doing quite well, whether it is hospitality industry, air travel, or four-wheeler sales, etc. But on the rural side, especially non-farm rural side, there is a concern, because if you look at the rural economy per se, in the farm sector, tractor sales have been exceeding numbers well above the even pre-pandemic levels, etc. People talk about two-wheeler sales as a one proxy for non-farm rural consumption being tepid, etc. But then we have also been talking to retailers and those who operate in that space, and the feeling is that we may have turned the corner because after 2-3 quarters of contraction, there is a slight positive blip in the fourth quarter.
The May two-wheeler numbers are good.
Also in the fourth quarter, January to March, rural consumption turned positive, even if it's a small blip for some of the fast-moving, low-priced consumer goods items. See, the thing is, the construction sector, as it gathers momentum and both residential and non-residential construction pick up, we will see outward migration from villages back to urban centers, and plus the government's couple of schemes in the rural segment itself, affordable housing and the water mission, etc., will also generate employment. Therefore, I do have a sense of optimism about the current financial year, that these numbers, that concerns we have about non-farm rural consumption, I think they would dissipate.
Okay.
That is the sense I have.
Okay, I'll just quote you some other numbers. While I agree that two-wheeler sales may have turned the corner. Yesterday we had a conversation with an FMCG biggie, and he was giving us industry numbers, not his numbers. In FY23, he says FMCG grew for the industry by 8%, volume minus 4%, price plus 12%.
Right.
And the other number that was even more, worrying is that rural is still contracting 3%, urban is growing 3%. And so for the fourth quarter, it was flat volumes. That is the big worry.
Right. So the FY23 you pointed out, right? That's why I also said the first 3 quarters of FY23 on specific items which are consumed by low-income segments of the population, they were contracting, and that is what we heard from some retailers we spoke to. But what they say is in the fourth quarter there was a pickup. There was a small pickup. The contraction had reversed. I'm talking about only for the fourth quarter.
Flat.
Yeah, fourth quarter numbers. And as I said, as and when the construction sector activity further gains ground and then the incomes begin to rise and then the transfers happen from urban to rural India, I do expect that some of the concerns we currently have will dissipate. But you are right about the overall year data, and we are talking about slightly more granular shifts that are beginning to happen.
Okay. No, I'm building this for the next couple of questions. The Capex. Capex excellent. It's grown by 8.9, almost 9%. Outsized contribution is really from the government. We know that from anecdotal data that government, especially central government, is charging ahead. It's now accounting for like 7.7% of overall investment, which is very good. It used to be 5.5, I believe. Now, the point is, has it resulted in private capex? Anecdotally, that doesn't seem to be there. No,
anecdotally and even data-wise, it has. Private capital formation is picking up. It is no longer a plane waiting on the runway to take off. It is taking off. It is not a question of in the future.
Okay.
If you look at data based on cash flow statements filed by companies, we do track it from a private sector financial institution. In the first half of the last 3 financial years, 2021 until 22-23, 3 financial years, we only have data for the first 6 months because the end of the year data will come shortly now. It was 2.1 lakh crores or 2.1 trillion rupees in 2021, rising to 2.7 lakh crores 21-22, and then 3.3 in 22-23. Then you look at the new project announcements data that the Center for Monitoring Indian Economy provides, and then you look at the fact that you speak to bankers, they say they are not seeing loan demand from industries, not because they are not investing, but because they are flush with internal resources. themselves. And I think there are very definitive signs. We also heard from several industry participants saying that they are seeing capex pick up. Steel and cement, there is no more room for...
so steel and cement is doing well.
Yeah, but
I'm worried about other sectors.
There are also other sectors where we have seen in the fourth quarter, based on 1,900 companies data which we have checked, there is a momentum. The question is the magnitude of the pickup in capex may be different across different sectors, but the direction is positive and it is growing. In fact, if anything, just as I mentioned to you earlier, that my risk around the 6.5% has become more balanced other than weighted towards the downside is largely influenced by the signals I am picking up on private sector capex momentum.
Okay.
Yeah. So so obviously we will begin to see that in the data. So that is why I am becoming more comfortable with my 6.5% estimate. It is primarily because of this.
Okay. Well, I saw data to the contrary, but all these are studying corporate numbers, and therefore it's one study versus another study.
Okay.
But what I'm driving at is that it is still central government capex which is the motor, which is fueling much of the growth, whether it's construction or whether it is GCF, gross fixed capital formation. This is an election year, and every past election years, you normally tend to see revenue expenditure or government transfers usually increasing. And this year there is more reason, because we are seeing private consumption in a lull. At best, your theory is that it may be flat, it is not contracting. So that is the big fear of the stock markets, investors. Will government slow and take away from capex and go over to revenue expenditure or transfers? Because it is an election year and because there is a need. Consumption is lagging.
No, there is no thinking at this stage. We believe there is no thinking at this stage to de-emphasize the public investment expenditure that was penciled in the budget and to shift it. Because we do believe that the government is continuing to provide adequately for the consumption needs of the population, especially the low income and poor segments. And we also believe that organic growth will begin to happen. So there is no thinking at the moment that there is a need to shift resources from productive to non-productive transfer-based expenditure. There isn't one.
Anything you've noticed in terms of state government capex picking up?
So again, state governments, we know that there are capacity issues and spending capability issues and so on. But again, I would say even there, I would say on an actual to actual basis, incrementally, state capex has registered a positive growth in 22-23. But the year has just got over when we wouldn't have got data from all states. But we do believe it will be in high single digits. In terms of the growth in state government-led capex.
Okay. Right. With this, let me come back to what you first raised in terms of India's external performance and the likely global headwinds. Do you see a greater deceleration? There are, like I quoted the Goldman Sachs report, their chances of lower recession,
lower chances of
recession in the US, but that is also coupled with therefore the Fed likely to have one more rate hike. So do you fear that later on in the year we could have more severe global headwinds?
No,
what's your own draw?
Yeah, I'm not sure that even if the US were to raise rates once or twice, I don't have clarity on that. I really do not believe that it would make a huge difference to our economic prospects. If anything, as you saw in the last few days, there was sort of a unilateral production cut by Saudi Arabia on the oil side, but so far it has not had a big impact on the prices of crude oil. It's simply because I think the general feeling is that at the margin, if anything, you are more likely to see global growth momentum slowing. We can discuss whether the momentum deceleration is how strong or how weak it is, but that is what we expect on the back of the last 1 year of rate increases, and in some countries rate increases are still happening, for example Australia, etc. So I do not see headwinds having weathered all these aggressive rate increases in 2022 and sort of into the initial months of 2023. I don't see them creating big headwinds for us.
Okay. That will be important as we go ahead. One factor in terms of external, which seems to be disappointing us, we've done very well in exports, services exports, and I'll come to that in just a bit. FDI, the latest number which RBI released is looking a bit, disappointing. Not scary, but disappointing. We've done, at least net FDI is about the lowest in like 7-8 years.
Yeah, that's also because there was sort of outflows and both on that's the overall number including the FII flows, if I'm not mistaken.
No, FDI outflow, inflow, the net has fallen to some 28 billion.
Yeah, so normally we would be in the range of about 35, 32 billion.
Last
so
3-4
about 20%. You should also remember that this was a year of massive rate increases in the developed world, commodity price shocks and geopolitical developments, which in general make people sort of sit back and take a relook at their situations and investment plans. So this could be a period of a pause that refreshes. And that is the way I see it. I wouldn't be reading too much into these numbers, because what we are hearing also is that a lot of companies are indeed stepping up their plans for locating in India. And given it was an extraordinary year in 2022 in terms of commodity prices and interest rate increases, I wouldn't read too much into this number. And it is good that it also happened in a year in which overall India's external situation, starting from a position of concern in April-May 2022 to a position where we are quite comfortable with the balance of payments and the current account deficit, etc. Not only in 22-23, but also going into 23-24 as well.
On currency, do you think that persistent depreciation of the currency, or at least not allowing it to appreciate, is the right way to forward?
No, again, I don't think that the central bank has a doctrinaire approach to the exchange rate. They are looking at what is happening to other emerging market currencies, particularly in this region, etc., and accordingly they will be calibrating their stance. So I don't see this as some sort of a bias towards persistent depreciation.
Well, I have to take a commercial break, but Dr. Anand, I have many more questions on the FDI issue, what the government is thinking about on PLI, back in a jiffy. Welcome back. We have been speaking with the Chief Economic Advisor, Dr. Anantha Nageswaran. Well, Dr. Anand, we were speaking about FDI having dropped off a bit, and your point was that it could be because globally interest rates rose. Now, Citibank has done some research on FDI in the PLI sectors. And even that, after jumping from about 4 billion in those sectors to about 7 billion in FY21 and 22, again has dropped off in 23. To about 4 billion. I mean, going back to the pre-PLI period.
Right.
So does it worry you that we may be getting something wrong in manufacturing itself, that people are not getting interested? Will the government think of any policy tweaks in PLI or generally?
It is difficult for me to provide you speculative answers on this point, because we also should not be reading too much into one quarter or a couple of quarters of data when there are so many other factors that are also happening simultaneously. Purely from a logical perspective, if everything remained constant and this was happening, then you should be worried whether this is the only factor that's influencing this kind of drop off and so on. But you also have lots of other things that are other moving parts, rate hikes, global uncertainties, commodity prices and war and overall, and then there was a reopening in China post-COVID, so there will be some attention focused there to see whether something needs to be topped up there, etc. But also what we are picking up anecdotally is that there is clearly a lot of planning and thinking going on in realigning global value chains, etc. And India figures very prominently in those discussions. That is why I would not read too much into this. While certainly we need to keep an eye out for it, and whatever we need to do to make investments in India a worthwhile proposition for investors, domestic or foreigners, we should continue to do that. There is no getting away from that. But I would distinguish that from reading too much into near-term data.
Yeah, then I'll just add one more data, which I think is worrying in terms of our manufacturing performance. We have been trying to emphasize manufacturing services are doing well, let's concentrate policy action more on manufacturing. Look at the GDP data on manufacturing.
Right.
That's also 1.3 for the full year. Yes, fourth quarter is 4.5, but that comes off a 0.6% base.
Yeah, absolutely.
So we're getting it wrong in manufacturing somewhere.
I mean, I agree on the data, but I disagree on the conclusion you were drawing. I mean, second and third quarter were bad for the manufacturing sector in the GDP data. And first of all, our quarterly data are not seasonally adjusted. That's fine. But then you look at the PMI indices on manufacturing, they are at a 31 or 34 month continuously above the expansion zone. And I think again, if you look at the last calendar year or financial year FY23, commodity prices and interest rates and input costs went up tremendously. And manufacturing therefore would have stepped back, and they would have also probably been cautious about running up inventories if demand was going to be weaker. So I agree that that is something we would look forward to seeing pick up substantially, given the strength we see in the PMI data, given the strength we see in IIP data, etc. But I don't think I would reach the conclusion from there to say we are getting it wrong.
Now let me come to the one where we are doing very well in services. Whether we look at the GDP data with the financial services 14%, I think for the full year, and if you look at exports, services exports, non-software services exports, absolutely an eye-opener. I mean, it's not 200-300% is where we are going year on year. Do you think this is good to go, and is the government looking at
No, this has happened because over the years of the investment in our capabilities and our skilled population, education, etc. And it is no longer only about software services, it's about even legal services, accounting, risk management, compliance, everything is happening from here. And I think whatever the government can do to facilitate it, the government will be doing it. I don't have specific answers to your question, specific measures in mind. I personally think this global capability centers, apart from software areas, is something that has just begun. Okay. And I think I do see services as being an important mainstay of our export basket.
Okay, so a big runway, you think?
I think so. I think the path ahead is quite bright, and it will continue to provide great sense of balance and stability to our external data.
Okay. I'm being warned I'm out of time, so let me ask that one tricky question, which is not really macro economy, but something that niggles, and you wrote about it in the Indian Express. This 20% tax collection at source. It does seem like it is too much of a pain in the neck for, of course the money will come back in advance taxes or whatever, but you're punishing someone who's paying their tax well because you have not been very successful with the evaders. Is that even fair? It looks penal at 20%.
No, the government has heard many of these concerns being expressed and the disappointments, etc. The government is cognizant of them. I think the government will come up with a response. They already are coming up with responses exempting income spending up to a particular level, 7 lakhs, and that may even and also it may also lead to further improvement in the process of linking TCS to TDS, which will then completely take away the concerns.
It's not definitely.
It is not going to be happening quickly because it's a technical issue. Some technological interventions have to be made to make sure that it is seamless. But once that is done, then people will not notice. They will shrug their shoulders and say it's going from this or this. Totally, I'm not being hit additionally, etc. So I think the government has definitely heard all these concerns and disappointments, and they are working on it.
Thank you very much, Dr. Anantha Nageswaran, for giving us time, and we take back this positive takeaway that the government will persist with Capex and that it is also thinking over the tiny niggling problems that we have expressed. Thank you so much for joining us.
You're welcome.